Many people have financial savings. The question therefore arises, what to do with capital if you manage to save about $1,000? It makes no sense to keep banknotes at home because inflation will slowly absorb them. The best solution is to invest $1,000 in some kind of financial instrument. In this video we will look at what options the investor has and find out how much you can earn from them. Shares. Shares are securities that give the owner the right to participate in the management of the company and receive a part of its profit. The investor makes money on the difference between the purchase and sale price of a stock and on dividends. To buy shares, you need to open a brokerage account and add funds to it. You can buy on your own or through a broker. Stocks aren't the best investment options for a couple of years because it's a rather volatile instrument and is more suitable for speculation in the short term. If you need the invested money in 2 years, then it's better to include stocks in the portfolio in a minimum amount and form the portfolio from stocks and bonds so that the yield of bonds covers a possible drawdown on stocks. Shares are a suitable option for a long-term period. Over a long period of time, most stock markets are still growing despite the crisis. The yield of the American market is 9 to 12% of the average annual return. The profitability can be even higher, it all depends on the period and the risk level of your shares. Bonds. Bonds are debt securities through which the issuing company raises money. Roughly speaking, this is an ordinary receipt which indicates how much and when the organization will pay the holder. You can make money with bonds in 2 ways. Coupon payments. This is a kind of analog of interest on a bank deposit. The coupon is paid twice a year. The difference between the buy and sell price. Often, securities are traded at a price other than par. To make money, you need to buy them cheaper and sell them when the value rises. There are many types of bonds, so it's easy to get confused about them. The best option for a novice investor is to buy corporate securities with good liquidity. They are easy to sell, so they won't become a waste of time in your portfolio. ETF. ETF is an investment fund, the shares of which are collected in a specific set of securities. An investor can buy ETFs on the exchange and get a ready-made portfolio that would have required hundreds of thousands of dollars to build on its own. You should not expect a large return due to a large number of assets in the fund. ETF is suitable for conservative investors who want to preserve their capital. The distribution of funds is a private matter for every investor. Some people care about security and prefer bond-based ETFs, while others want profits, so they buy stock funds. Experts advise to proceed as follows. Allocate 10% of the portfolio to the gold ETF. Buy bond funds by 45%. The remaining 45% will be distributed among stock bonds. Collectibles. Rare and antique items can be not only a decoration, but also a valuable asset. Statistics say that investments in antiques and collectibles can generate 15 to 30% of net profit per year. In addition to high profitability, this type of investment has 2 more advantages. Capital protection against inflation, not susceptible to crisis. Unfortunately, it also has disadvantages. Long-term nature of investments. Immediately after creation, rare things are of little interest to anyone. These items acquire value only after a few years. Low liquidity. Selling collectibles is hard. This is a rather specific asset that is in demand among a narrow circle of people. The search for a buyer sometimes takes months. Experience is required. An amateur can easily mistake a fake for an expensive item, or pay much more for a thing than it really is. Buy only what you know or use the services of independent appraisers. It's better to pay for expertise and sleep peacefully than at the most inopportune moment to find out that you are keeping a fake. You can invest $1,000 in rare items through online auctions. The largest of them are eBay, Amazon, JD, Etsy. After the price of items increases, you can sell them on the same site. Unfortunately, no specific recommendations for purchase can be given. You can earn money on literally everything, from toy train models to military items. The main thing to remember is that when buying an original, you don't risk anything. Sooner or later, it will rise in value. Cryptocurrency. Cryptocurrency is an asset that appeared in 2009. Those who saw its potential then became dollar millionaires. Unfortunately, the time of capital tripling has passed, but it's still possible to increase your capital. To do this, you need to correctly select assets and create a diversified portfolio. It must include 2 coins without fail: Bitcoin, Ethereum. It's desirable that the share of Bitcoin in the portfolio doesn't fall below 50%, since it's the flagship of the entire cryptocurrency world. It's the movement of Bitcoin that determines which direction the market will go. If you wish, you can dilute the portfolio with top altcoins from the top 10 of the CoinMarketCap rating. It isn't worth buying coins from the second or third 100 of the rating. Indeed, sometimes they skyrocket in value, but identifying such an asset among hundreds of options is like a lottery. With a probability of 99%, sooner or later you will get a minus, and not the fact that you can get out of it. It's easy to invest $1,000 in cryptocurrency. Just buy it through an exchange or a specialized peer-to-peer platform and wait for the price to rise. Wine. Not all bottles are suitable for investment. Investment-grade wines are specially made, given the additional revealing of aroma after years. The longer the wine is stored, the more expensive it becomes. You can buy and sell high-priced wines and monitor the value of your portfolio on the British Wine Exchange, London International Winters Exchange. According to experts, about 90% of investment-grade wines are produced in the French region of Bordeaux. Often the weather influences the uniqueness of the wine and the growth of its value. For example, 1978 and 2008 became unprofitable years for Bordeaux, and 1998, 2000, 2005 and 2009 became profitable. According to Knight Frank, 2019 was a bad year and elite wines bought investors only 1% per annum in dollars. But if we evaluate the general trend, then over the past 10 years collection wines have risen in price by 120%.